All right, let's take a video question right now from Melina in Toronto. Go ahead.
Hi, it's Melina from Toronto. My dad and I like to invest in companies we know. So we bought Apple, Facebook, and Disney for my RESP. Will I double my money when I graduate in 7 years? Thank you. My dad's smart, but he's no Warren Buffett.
What was that last part? Something about Warren Buffett.
That's right. She said her dad's smart, but he may not be Warren Buffett. Well, you know, I think they're doing pretty well with their picks. So I guess if you do the math, that's just a little over 10% a year over the next 7 years.
Right.
You'd have to make. And you know, when you think about the growth rate at Facebook, which is substantial, and the addressable market that they have, and when you think about the stability and the content that Disney has, and when you look at the history of innovation that Apple has, that's probably not an unreasonable expectation. If you looked at the long-term return of the stock market at around 6%, these would be doing better. We believe that we are in a secular bull market for stocks where you tend to get better returns than the long-term average, and we think that comes over the next number of years.
Okay.
So probably the average stock going out over the next 10 years, you know, is high single digit, or maybe even 10%. So I think it's very reasonable to assume that. You're going to have some ups and downs, but I think it probably looks okay.
Would you or do you own all three of these stocks?
We own Facebook. We don't own Apple or Disney currently, but they're companies. I'm watching Apple very closely because, of course, they're coming into a new product cycle, and it may get interesting.
Okay. Remember, you too can send in a video question. If you send it, we will use it. And thanks, Melina, for that. Let's take a caller right now. John in Toronto, go ahead.
Yes, I'd like your guest views on Microsoft, if that was a good acquisition of LinkedIn, and are they a consistent grower of their dividend? Thank you.
Okay, two good questions. So first of all, on the LinkedIn acquisition, obviously there's lots of questions to be answered as to how they may integrate or may not integrate that purchase. If you think about it intuitively, you know, if you could integrate all of the information they have on their 500 and some odd million subscribers at LinkedIn into contacts and ability to get information about people you had meetings with, there's a lot of interesting things you can do there. So they probably can drive some revenue out of that. So I think it's probably an attractive purchase because it protects their position in the enterprise and in commercial ventures. When you look at the rest of Microsoft, we like Microsoft. We own it. We didn't own it for many, many, many years.
Right.
But they're doing a good job of converting their revenue base to a subscription-based model, both through their software, Office software, and then, of course, their cloud business, which is growing at over 100%. So we think that there's lots of growth room for them there, and they can grow their margins. I think they've got still quite a number of jobs to cut. When the new CEO joined, he said he's going to cut 25,000 jobs, so there's room for margin expansion. And they've grown their dividend at 11 or 12% a year over the last 5 years. And so this is one of those examples. You know, you can get a 2% yield, plus dividend growth of probably 10% or more. I think that's pretty attractive.
David, did you buy any more on the weakness yesterday?
We didn't, but we don't tend to buy dips. We tend to buy strength.
Okay.
So we like to see prices moving higher as we're adding to positions.
Okay.
But we've got a pretty good sized position in Microsoft to be.
Okay. Let's take another caller right now. Alan, Ottawa, go ahead.
Good evening, Catherine and David. I've held CVS for about 2 years, and the first year was a pretty good year. And in the last year, it's moved sideways to a little bit down. I was thinking of selling it this afternoon, and in looking at a few things, it's still on most people's buy list. So I'm just wondering what David's thoughts are on it.
Well, look, CVS has a great business. The drugstore space has been tougher over the last couple of years. We prefer, if you're going to be in retail, something like either the dollar stores, low-priced retail. We also like home improvement companies like Home Depot, which I've spoken about quite regularly. You know, it pays a 1.8% dividend. It's going to grow its revenues at 12 or 13% this year. Technically, though, it's not one of the stronger performing companies.
Mm-hmm.
We tend to look for the strongest performing companies in the group. And so this is a neighborhood we've avoided a little bit. You may want to move on to something new.
Okay. We're going to be back with David Burrows. He's President and Chief Investment Strategist at Barometer Capital Management, answering your questions about North American large cap companies. You can call us toll free 1-855-326-6266.